Welcome to the Liquidity Event, a show about all things personal finance with a laser focus on taxes, financial independence, and equity compensation. Hosted by AJ and Shane of Brooklyn FI, each episode will focus on a personal finance topic, some driven by news headlines and sometimes driven by listener questions. And sometimes you'll just get two money nerds rambling about what they think is interesting. Just a quick note before we get started, this podcast is for informational purposes only and should not be considered tax or investment advice.
And welcome to the Liquidity Event. We're your host, Shane Mason.
And I'm Allie Jane Ayers.
Oh, we're going full name, all three names. In that case, I'm Shane Paul Mason. And this is episode 144, being recorded on April 22nd. This will be airing on April 25th. Ladies and gentlemen, the Pope is dead. A quick reminder for you listeners, we will answer your questions on the pod. If you leave us a message, you can disguise your voice, use a fake name. If you're shy, the Liquidity Event link is at memo.fm/liquidity event. AJ, how are we doing today?
I am doing very well. Yes, the Pope died. Very sad. I am honestly so excited for the conclave because I just saw the movie Conclave, which I loved. And now we're going to have a new Pope. And I feel like a lot of people are much more well-versed in the process of choosing the next Pope because they saw this Hollywood representation of it. And I think we're all going to be rooting for who's in your bracket? For
Isabella Rossellini.
March Madness. It's May Madness. Who's going to be the next Pope?
Surprise winner, me. I'm the next Pope.
You're the Pope. I went to Catholic
school. You got
to
change the system from the inside out.
Yeah, there you go.
You went to Catholic school? What high school did you go to?
I went to Beverly Hills High School, which is a public school, but I went to a Catholic all-girls middle school named Immaculate Heart.
Beverly Hills High School might technically be a public school. What zip code was that in, AJ?
90210. Yes, that was my zip code.
Okay, so you're saying that your zip code was so sought after it had a whole show about it.
Show about it. Anyway, but I went to Immaculate Heart for middle school, so I actually know a lot about Catholicism, and it's a super interesting religion. I love Catholicism.
I went to a Catholic high school.
Catholics and Jews, lot in common.
I got kicked out of a Catholic high school.
Oh, yeah.
All right. On this week's episode of the Liquidity Event, we have a very special episode. We're going to do an evergreen episode about everyone's favorite topic, mortgages. Psych! Non-qualified stock options.
You're funny today. You've made me LOL legitimately twice. Usually I just roll my eyes when you're trying to be funny, but
I think you just like that I have a matching hat and shirt on. I did a little.
Yeah, your aesthets are also pleasing today.
And this baby blue eyes, dear listener, you need to get on the YouTube because I am staring into your soul today when I talk about non-quals. I had my birthday over the weekend, by the way. I turned 30. Sorry, we had an editing issue there. But I'm on the back nine of my 30s. Right? Yeah, if you take a 3 and you make it symmetrical and flip it back around, you have to bring up 30. All right, this is supposed to be an evergreen episode. Let's get on topic. I'm old.
Shane
gums
is 33
are receding.
Forever. He's evergreen, just like non-qualified stock options.
I'm going to sell my soul to the devil pretty soon before I turn 40. Just to keep it.
Perfect. Just get Botox.
Blues.
The devil is out of business. All we have to do is get Botox. You don't need to sell your soul anymore for eternal youth.
After watching The White Lotus, yeah, have you ever seen someone do Botox in person? It's really kind of jarring to watch a needle go into someone's face and fill it up with plastic. But kind of chill. You don't need.
I have not.
You're very lucky in that you'll never need it.
I don't know about never, but yes, I do have a youthful appearance.
That pregnant pause, dear listener, was AJ trying to decide how to respond to a compliment. All right. Let's get into it. We're 3.5 minutes into this recording, and we haven't said anything about non-quals yet. We'll have some more fun.
Except that you're not qualified.
I'm not qualified for this podcast. You're not qualified to give financial advice. Dear listener, AJ has a Substack that she's been killing it on, and the real CFP heads, I think this is probably in every industry where there's two sides of a spectrum. There's people that are very hyper-focused on the technicalities of the profession, right? Because we are in a profession. Our job is to enhance society by, committing to developing things that are positive for the world. Of course, you're going to get paid well as a doctor, an accountant, or a financial planner, a lawyer, but there's the technical side, and then there's people that actually want to focus on done rather than perfect, right? And AJ's Substack is all about getting the word out about how to save for retirement, how to budget, other topics you want to talk about right now, AJ. But
yeah, invest, just like how to get started on investing. And like, my goal is like to reach people and get them started, not debate the intricacies of Roth versus traditional contributions in your 401k over a lifetime. Like,
there's
anyway,
500 articles about that
Yeah.
stuff that don't get any traction except with other CFPs that like already know the answer. Like also like who cares? Like anyway, so yeah, I'm sorry that you're getting heckled from the cheap seats. Yeah.
I'm happy to engage. And that's the thing. It's like, it's great. It's engagement. Like that's what everyone who posts anything online is after, is engagement. But yeah, it's getting a little exhausting when folks come after your every post and point out what you said, quote unquote, wrong. And like, sure, if I'm wrong, I'm happily admit it. It's like, I'm not wrong. I just had an opinion that 401k is awesome. Everyone should contribute to one. But of course, someone who teaches that for a living as a professor of this for 15 years, like they're right and I'm wrong. So it's fine. A little healthy debate. Never heard of it.
Well, there's a lot of metrics out there. There's impressions, there's reposts. I think haters is another metric that we should, metric that should we be tracking here on.
I don't have enough haters, which means I'm not saying anything interesting enough. So I got to go back to the drawing board. Anyway, let's go back to the drawing board and talk about something boring.
Let's draw a big NQSO on the board. AJ, if you had to guess what non-qualified stock or NQSO, give me a funnier acronym than non-qualified stock option for NQSO.
No quails simmering.
Yeah, I mean it might not be. It's not quite so obvious what NQSO stands for, actually. So what else might not be quite so obvious? Little b, lowercase b in the middle there. We've got 10 potential questions we're going to get to today. We're going to see how we do on timing. Let's start from the top, AJ. Let's do a little back and forth. What's the biggest mistake you see employees make when they first receive NSOs? What should someone do in the first 30 days after getting a grant from their employer that includes NSOs?
Biggest mistake? I'm going to go with ignoring them. That's the biggest mistake people make, is like, what is this? I don't know what this equity is. Like, I'm going to throw this in a drawer. I got a new job. I'm going to forget about it. These are worthless. And they just forget about them. They forget about this grant. So I would say that's the biggest mistake, is just not realizing that you have the potential to unlock liquidity, of the potential to unlock wealth, because your company has granted you the option to purchase a share at a certain price, right? So if you get non-qualified stock options, typically we see them granted to you when you join a company. Probably there's a vesting schedule attached to them. Maybe it takes, 1 to 3 years for them to vest as you're working for that company. And you just don't do anything with them. Non-qualified options specifically, which I'm sure we'll get into, are very interesting because, in my opinion, you have the most control over non-qualified stock options versus incentive stock options, or even RSUs, which we've covered in previous podcasts. So I like non-qualified options because they're kind of simple, but I'm afraid of them, and I'm afraid for people who have them because you have to make more decisions. As an individual, you have more agency, more control, which means you can get decision fatigue. What about you? What do you think the biggest mistake is? That was kind of a cop-out answer, but
no, I like that answer. I like that answer. I mean, we're going to see the Reddit question later that we're going to answer is kind of relevant to your answer. Is kind of relevant to what you just said. There's somebody that totally forgot that they had value and they're about to expire, and they've missed opportunities now to exercise their options when it would have been less expensive for them. I do wonder overall how many non-qualified options, on average, there's got to be studies on this, how many of them are underwater perpetually, like are just never worth anything. And I think that's why people see them as like funny money or a gamble or something that isn't, that's why they ignore them, because it's not just straight up wages that they receive. So I'm going to piggyback off of you off that one and say that people just ignore them. They don't realize what type of value they can have. I think they're more worried about their salaries. Like if they're doing very well at the company, or if the company's doing very well, then there's going to be a lot of promotions available, a lot of raises available, and they don't really think about the equity value of the options of the actual company. Because most people, just by the very nature of our society, are not entrepreneurs that think about equity value. Most people are employees that think about their salary. So I think that's just where the focus is for the recipients of non-qualified options.
For sure. Yeah, most people think about their cash flow. That's what they're concerned with. It's hard to think about the potential upside if you're not the owner, if you didn't start the company. It's a hard mindset shift to go from employee to owner. And if you have options and you exercise them, or you're granted shares in your company, you are an owner. Congratulations. I got a tax question for you, Mr. Mason. How do taxes work when you exercise NQOs? And why is it so easy to get blindsided?
Why are you asking me? Why would I know anything about this? It hasn't been my focus for 15 years. I'm going to be listen, AJ, you got to do a Roth and a traditional 401k analysis here. Listen.
Sorry. Can we just get one thing out of the way? NQSO, NQO, NSO, all exactly the same fucking thing, right?
Yeah.
All the same shit, folks. I call them NQOs. Some people call them NSOs. Whatever. Anyway, just had to get that out of the way. All right. How are these bitches taxed?
Salary, client, customer. Yeah, whatever. It's all the same.
How are these motherfucking non-qualified stock options?
There she is. When it comes to taxation of NSOs, and kind of circling back to the first thing.
Oh, you're going with NSO? Okay, fine. I'm going
whatever.
NQO,
I'm going to go interchangeable. When it comes to non-qualified options.
You're interchangeable?
Hey, listen. That is.
Gotta get John on here.
Look at these blue eyes, deeper than the Pacific Sea. All right. The taxation of non-qualified options rests on the fact that they are wages, essentially, because what they are, the way that the IRS or that the Congress sees them, is that they are compensation that you receive in exchange for services that you perform for your employer. Therefore, they will be subject to regular payroll taxes as well as regular income tax, and they won't qualify for special tax treatment like you might see with incentive stock options or with capital gains when you exercise them. They could be subject to capital gains later, because what you are doing is you're paying a set price, which is called a strike price, to purchase an option. And hopefully the fair market value of that stock will be much higher than the strike price. And I imagine in 99.9% of the times when people exercise their options, probably 100% of the time, they are going to have more fair market value, as in they're going to be worth more if you were to sell them to a third party, than what your strike price is. The gap between the fair market value and the strike price on the day that you exercise that is your income, just as if you've been paid in cash. It's going to be subject to ordinary income taxes and payroll taxes. Even though you have not received any cash, yes, you are paying to buy stock. So I think this is one of the reasons why people ignore their options, because they have to pay to acquire stock in a company that they work at. But yeah, you've acquired this stock now, and you might not even be able to resell it, but you're going to be paying taxes on it. Now, of course, if you're at a public company, you can sell that immediately back into the public market to whoever is purchasing that stock. But if you're at a private company, then there won't normally be an available buyer for the stock that you just purchased, but you're going to have to pay tax on it anyway. So
Right. So as financial advisors, I feel like we often encourage our clients to exercise and hold incentive stock options because there are not a ton of tax consequences. There's AMT, all that jazz. Whereas with non-qualified stock options, if there isn't a public market, typically we are often advising clients to wait until there is a public market to sell them, because it's just wages. It's just ordinary income. Question for you. Mm-hmm. When would you want your strike price that's in your grant to be equal to the fair market value of that stock?
Yeah, I mean, well, if you know without a shadow of a doubt that the value of this company is going to go up and to the right, and you're going to be able to sell it at a very high value, then the iron is hottest, so to speak, when the fair market value is equal to the strike price, because if you exercise then there is no delta between the fair market value and the strike price. So there's no income tax that you have to pay upon exercise. You're only going to get capital gain treatment, I shouldn't say only, because it's a very positive thing to get capital gain treatment a year after you exercise the stock, because once you've held it for a year and a day after you exercise, then you get special tax treatment when you sell it down the road. So if you could see the future, you would exercise on the day that the strike price is equal to the fair market value. But if you could see the future, you wouldn't be working for a salary. You wouldn't be working for wages.
I was leading you. Here's what I was thinking, is that when you would want that is if you're leaving the company, right? Let's say you've been at this company for 8 years, and for some reason the fair market value hasn't gone up, or maybe that's not realistic. Maybe it's 5 years and the company hasn't seen a lot of growth because of a recession or what have you. You got to go get another job. You're stuck with this company and you want to exercise. You believe in the future of this company. So you go ahead and exercise. You would only have to pay that strike price if your strike price is equal to the fair market value, you wouldn't incur any additional income tax. So that's when you'd want to cross your fingers and hope that the fair market value is not significantly higher than what it says on your grant documents as your strike price.
Yeah, that's a lot of jargon. So if any of these listeners
boy.
out here want to hear, like, I want to understand what's going on, we're available for discovery calls, of course, to explore your non-qualified stock options. But hopefully this is, you can follow what's going on here. If you have these options, all of this jargon is definitely relevant to you. And if it's, if they're worth any money, then we need to start to understand these options, just like you would need to understand pre-tax deductions on your paycheck.
For sure.
Cool. So we got a couple more items here that might be relevant to people. Like, some people hear options and they think about the alternative minimum tax. Do non-qualified stock options impact do we have to worry about those with the AMT, AJ?
No, you don't have to worry about it when you're exercising non-qualified options. However, if you have incentive stock options and non-qualified options, we can play a game. We could do a tax projection, and we can actually create a favorable tax situation for ourselves where we're not paying AMT on our incentive stock options if we exercise enough non-qualified stock options. That's like level 303 here. Maybe not for this podcast, but yeah, we don't have to worry about the AMT if we're just exercising non-quals, but there are opportunities for more advanced planning if you've got more than just NQO alphabet soup. If you've also got ISO alphabet soup.
Yeah, alphabet soup.
ISO on the internet is in search of, right? Like you say, like ISO, a new gardener or whatever, a new landscaping company. But every time I see that, I'm like, oh, ISO. Oh, right. We're not like, I get so excited as an equity nerd.
Yeah. Well, there's also like the International Standards Organization, which determines like the strength of tensile steel or like SOC compliance for software companies or something.
Right. Oh yeah, that's the other one. Right. Yeah. SOC 2 or whatever. Yeah. It's an overused acronym, but anyway.
I'm so confused. Okay, so I've got a question that's not on the list here, AJ, for you. What if I've got multiple grants of non-qualified stock options? Let's say I've been working at this company 6 years. I've got strike prices that are very low from the early days. The company's done pretty well. We're on our Series C now, and every time that we've raised money, the 409A valuation, aka the fair market value, or the thing that's going to determine how much tax I pay when I exercise these options, keeps going up. So I've got really low strike price, I got medium strike price, and I got high strike price. How do I what's the bears and the little girl? How do I Goldilocks this scenario and thread the needle? Like, I don't think there's a right answer to this, but what goes through your brain as a financial planner when it comes to figuring out which options to exercise?
Do we have liquidity? Do we have a public market or a tender offer on the table?
Let's say there's a tender offer on the table.
Tender on the table. Okay, right. Yeah, because I was gonna say, if there, like, my first response is like, if there's not an option for liquidity, I don't see a really compelling reason to exercise non-qualified stock options unless you're going to lose them. To me, the only time when you would exercise non-qualified stock options is if your grants are expiring and you have to. Yeah, that's kind of the only time when I would want to force it. So yeah, how do we Goldilocks this? I mean, first of all, everything starts with the tax projection, right? We got to know how much income you have because I want to know, do we have quote unquote room in the budget? If we're already in the top tax bracket, I'm not super excited about paying more income tax by exercising the cheaper ones, but also the cheaper ones is less cash out of my pocket.
Right.
I don't know, Shane. I don't really have a good answer. Like, again, this is like there isn't really a right answer for everyone. Personally, what I would probably do is if I just felt like I had to exercise something, I wanted to participate, get some liquidity out. It doesn't really matter, right? Because it's a same day sale anyway, right? So if your cheapest, oldest grant, you'd pay basically the same amount of tax because it's two separate transactions, right? You're exercising, but you're borrowing the money from the person who's purchasing them from you. So it's kind of a wash, right? Depending on which grant you choose.
Yeah. There's so many things to consider, right? Like the high strike price, you're definitely going to pay lower in taxes. But you're going to pay more to buy the shares. You got to pay a higher strike price. You got to give more to the company. The lower, I guess you have to talk to the client and see like what their plans are too, because if they're going to leave that job pretty soon, some people, you can do some psychological have some conversations with that client about what their goals are for the next 5 years, because if they're going to leave that job, they could take a year off and really open up the bottom tax brackets for those other options that can fill up the tax brackets while they're not working. Maybe the spouse is going to take some time off. Maybe some kids are on the way, so we're going to have some tax credits in the future. You really have to, like, maybe there's going to be some changes in the administration with the new administration when it comes to taxes. There's so many different things that you can try to predict. It's not, and some people just want to rip it and get it over with, but you should really have a conversation about it, because you could have, 5, 6, sometimes 7-figure consequences, depending on the planning that you do.
Yeah, I was trying to think of like QSBS too. Like, is there a reason to exercise and hold non-quals to potentially
start the clock on the QSBS?
Start the clock on qualified small business stock, where we're potentially excluding $10 million of capital gains, totally tax-free. Like maybe that's my second sometimes good reason. But again, with anything, with buying these options, you have concentration risk, right? You're taking money out of your savings account or out of the stock market in a diversified portfolio and putting it into this one company. So we got to understand the risks, right? And I think a lot of friends and some clients that we have who are on their second or third startup have felt burned in the past, because either they exercised their non-quals and they laid cash out and now they're worthless, or they didn't do anything and they wish they had, because they didn't have 10 grand when they were 22 to exercise them and pay the taxes. And now that company went public and that little 10 grand would have been, $100,000 or $200,000 or potentially way, way more if we're talking about some of the biggest winners. So this shit is hard, folks. Like, I mean, you and I do have so much real life experience with this, and every single case that comes up that our planners and our CPAs are working on, there isn't always a clear answer. Right?
Yeah.
Like we built a piece of software to literally with an algorithm that's going to help us make decisions, but it doesn't make the decision for us. There is never a right answer. There's a tax answer, there's a risk answer, there's an emotional answer. And to me, the right answer is a combination of those three.
Yeah. That was going to be my next question, actually, which is also not on this list. So talk to me about how we at Brooklynify actually build financial plans for people that have, let's say we've got a 40-year-old who's been at a firm for 10 years. They've got a few $1 million of unexercised but vested stock options that are going to expire soon, and the company's going public. Just as a base case, talk to me about a 2-year, 4-year, 6-year exit strategy. Let's talk about the other, financial assets that they might have, and how diversification or concentrated position might impact our decisions, how taxes might impact our decisions, and how financial or how the risk of holding on to this single share of stock or single equity could impact our financial decisions.
Yeah, I mean, I'm just going to go back to that thing I just said. What's the Jeopardy? Question, answer, where you reverse the question.
You must answer
the answers
in the form of a question.
Right. So what is choosing from the tax answer, the emotional answer, and the risk answer? I think it's a combination of those three things. So, if someone doesn't want to experience the volatility of watching one single stock price bounce all over the place every second between 9:30 and 4 every day, they should probably just sell it all and move it into a diversified portfolio. They'll have less bounce, less volatility. I don't think that's often the best solution. I think spreading it out. But my favorite planning tip, or I don't even tip, when we build a financial plan around incentive stock options, Shane, I always start with how much do we want to keep long-term in 10 or 15 years. And for most people, that answer is something like, I don't know, a little bit. I want to have a legacy position to, celebrate my initial contributions to this firm. So maybe that's 5% of their total holdings. Maybe it's 10%. For some people, it could be 50%. So that's where we start. And then we kind of work backwards. And then it's running the numbers. It's running tax-aware financial plans of seeing, hey, what would it look like if we sold this all off in 2 years? Do we have enough room in the tax bracket for this to make sense to move this quickly? Otherwise, it might make sense to do this over 6 years if the client's more comfortable with that. And like you said, what else is going on in their lives? Do they need to buy a house next year? Maybe they fell in love with a house and they need the cash in 2 weeks. That's going to change our decision. And my beautiful tax plan to have them pay 15% less in tax over 6 years goes out the window because they need this cash because something else in their life came up that's more important than saving 15% tax and income tax.
Hell yeah. Hell yeah. Yeah, it's a huge decision, and it'll probably change every year. Like we might set up a 4-year diversification strategy, but with like fresh regrants coming in and with babies on the way and buying houses and the strike price, various strike prices available and various, the 409A changing or the public stock market changing, the price of the stock going up and down. You have to stay on top of that plan throughout that timeline. And usually people that have this amount of wealth generated, like they've built this amount of wealth for a company, they continue to do that for other companies down the line. They're very highly motivated, high income earners. So it only gets more and more complex as we get older. So
yeah, I don't remember where this phrase came from. I think it actually came from you. I don't know where you got it, which is we want to create a scenario of least regret, right? I don't like it when a client comes to me and says, "Fuck this company. I'm not going to exercise my options. I'm just going to let them go." Or a friend says, "I can't afford this. I don't want to exercise my options." I'm like, well, what if we just do like a little bit? What if we came up with a dollar amount? Maybe it's $1,000, maybe it's $10,000, depending on your net worth. And we just exercise a little bit where it's not going to be a huge financial impact. But what if this is a lottery ticket? What if the company that while you worked there in the early days had really bad leadership, then they got some new investors and replaced the CEO and now they're awesome. And now fast forward 8 years later, they're going public and you are kicking yourself that you didn't exercise that? Maybe we should exercise a little bit. So I'm pretty bullish on companies that make it to Series C, Series D at that point. So I don't know. I always like to encourage people to exercise just a smidge, just
okay.
a little bump.
Yeah. I got 2 more items for you here.
Just a key bump of
all right.
non-quals.
What's that? I have 2 more questions for you. The first one is I want to talk to you about somebody that is overly optimistic about their company. They know leadership and they are convinced that this stock is going to the moon. So they are so stoked to exercise as early as possible. We have maybe some early exercise options. Talk to me about like the substantial risk of forfeiture for early exercise issues, like what can happen if you get fired for cause, if you early exercise before they vest. Give me some, and like, should we be super optimistic? And talk to me about confidence bias or like availability bias or things like that, like where you work at that company so you think you can control it and you've got some insider information about where it's going.
Yeah. I mean, this is not an easy topic, right?
You've got 2 minutes. You got 2 minutes.
Okay, great.
Okay.
You and I are founders, so I'm sitting here telling our clients like, you don't know what your company's going to do, Like you have too much confidence. Let's tone it down a little bit. Let's diversify, right? We want to be diversified. We don't want to have all of our net worth in one company. That's too much risk, right? You and I know that very well. So if you can get some liquidity, we always encourage our clients to start to do liquidity and start to do it slowly. So I have had lots of experience talking folks off the ledge saying, my company's IPOing. I don't want to sell any. I want to sell 5% because I'm so bullish on this company. It's a negotiation, right? Okay, fine. You don't want to sell the 30% that I'm recommending, let's start with 5% this quarter, and then let's do 5% next quarter. And can we get to an agreement where we're getting some diversification? We're taking a little bit of risk off the table. You asked about substantial risk of forfeiture. Yeah, if you're an early employee or you decide to exercise your options, there are some provisions in options agreements that if you get fired for cause for doing something bad by management, you lose those options. And if they're non-quals, you've already paid income tax on them. Sorry, folks, that you already paid that tax. There's nothing you can do about it. So that is a bad situation. If you early exercise your non-quals, do not get fired for cause. Better advice, have your options agreement reviewed by a lawyer and have your lawyer push back and don't sign it if it has that clause in it. We've actually had some clients successfully negotiate that clause out of options agreements before. So, and we've also had clients who have been fired and lost that money forever. So you live and learn.
Right. Yeah. Cool. All right. Well, with all that said, thank you for that fantastic answer. Don't get fired for sexual assault.
Don't get fired.
I think that advice would qualify for the PhD guy, the guy that's teaching.
You are qualified. You're non-qualified.
Wait, hey.
What else you got?
We have one final question for us. It's a Reddit question from Personal Finance. First of all, I think this person might be disqualified from exercising. But with that said, let's get into their facts. And there's like 6 paragraphs here. So I'm going to keep it really straightforward. In 2011, I joined a small engineering startup in the AI space. By the time I left in 2017, which is setting off alarm bells for you, correct, Miss Certified Equity Professional? The company had gone through a few rounds of funding and gone from under 20 employees to a few hundred. It's now 2025. They left in 2017. This person is asking, in 2014, I was given around 11,000 stock options at a strike price of 75 cents. They're currently worth something because they just went through a Series E funding this year, and they're asking if he should exercise or not, or if they should exercise or not.
Too late. 2011? Yeah, 2021 was their last time, right?
Well, no, they were the company started. They joined in 2011. They stayed till 2017, so they were there 6 years. But they in 2014 was when the grant happened. So I think that's why they're asking. They have like 10 years. Maybe most grants, by the way, dear listener, expire after 10 years. So
unless you work at Spotify, then they're 5 years.
To be clear, this question is a year old, AJ. So this is from 2024.
Gotcha. Okay.
Yeah.
Okay. So they're within the 10 years.
Yes. So they're within the 10 years. But like my questions are, they're like, should I reach out to the people that still work there? Should I exercise this? I don't know anything about the financials of the company. If it's gone through a Series E, like it's obviously trending towards a liquidity event. My first concern is that usually when you leave a company, you have 30, or if you're lucky, 60 days to exercise your options when you leave before they just automatically expire and they go back to the company. So I'm a little worried about that, but let's assume
that's the default, right? There are carve out provisions. So there are some companies that will give you the full 10 years, but folks, the default is after 90 days, you've lost them forever.
Yeah. So with that said, what do you think about somebody, should they exercise? I guess this person doesn't have the 409A, which is unfortunate because they don't know how, like we said earlier, the taxation is the difference between the 409A, aka the fair market value, aka FMV, and the strike price, which is 75 cents here. So, I mean, his grant was from 2014. 10 years later, they're through a Series E. I'm sure they've probably at least quintupled in value, the 409A over that period of time. So this person's going to be paying a lot of tax for a company. If they're able to exercise, they're going to be paying an unknown amount of income. They're going to be receiving an unknown amount of income, right? Because they don't know the 409A. They just
don't know what the bill is. Yeah.
Yeah. And they're going to get a W-2.
They're ordering the caviar and they don't know what the price is per pound.
There's an AJ allegory for AJ metaphor for you. And
folks, it's happened to me many times.
There's the Beverly Hills High School metaphor for the deer. Let's circling all the way back to minute 1 of the pod.
I always ask the price, folks. I always ask the price.
I had some caviar over my birthday weekend with Mama. Mom likes caviar. Did you know that? Mom came.
She's a well-traveled, well-seasoned woman.
I've got a great omakase for you
taste.
next time you come down
to
Mexico City. I had a great time. So anyway, dear listener,
always get the caviar.
I think that this person needs to get in touch with management if they can. I think a lot of people are afraid to go back to their old employer because they have a bad reputation or bad relationship. I mean, it's a little awkward. It's a little taboo in America to talk to your old employers, right? You feel like you're just bothering them. But when it comes to equity compensation, this happens all the time. You've got this form of compensation that's deferred, and it can be deferred to after you leave that company. So you have to have a good reputation or a good relationship with these people after you leave if you've got the equity compensation in your inventory, because you're going to need to talk to them. They're going to do some tax reporting. They're going to need to know your address, what state you're in, so that they can report your income to the right state, etc. This person needs to get in touch with HR, is my opinion, so they can have an idea of what type of taxable consequences they're about to experience when these exercises take place. In my opinion, I don't know this person personally, but it sounds like this company is moving up and to the right. They've weathered the storm of 2022, 23, and 24 in terms of the IPO desert or IPO winter that we've gone through. And this company continues to raise money after all the VC money has dried up. So I'm imagining this company is snowballing towards a liquidity event, so to speak. So my gut reaction is for them to get in touch with HR and figure out and exercise earlier rather than later to minimize their taxes, but make sure that they have the liquidity available to pay that tax bill now ahead of a big liquidity event during an IPO.
Yeah. And, they could have, my advice to our clients is always on the way out when you're leaving a job for whatever reason is make friends with HR, make friends with the equity team, or at least have their email addresses and their cell phone numbers because you're going to need to get in touch with them at some point. The other thing I was going to say is so like this person, let's say they get some advice from Reddit, great place to get advice. And Reddit says, Series E, it's going to go public next year. Right. And this person goes, well, they get a tax projection done. It's going to cost them $100,000 to exercise and pay the tax. They don't have $100,000, so they go take a personal loan out. Well, now they're leveraged and they're in the red for this highly risky, definitely not guaranteed company stock. So generally, I try to avoid borrowing further if your net worth cannot cover the exercise cost and the tax. There are third parties that will loan you the money. ESO fund is one of them that we've done deals with before, which is a nice way to mitigate the risk and have someone else take on the risk and have that cash up front to pay the tax bill. So don't love the idea of borrowing to exercise company stock when there is not a active public market. And by the way, folks, an S1 being filed does not mean that your company is going public. We just I saw a New York Times headline this morning about Chobani is opening another plant in New York because they're going to try to get the growth to try to go back to potentially do an IPO. Shane, you and I talked about the Chobani S1 being filed in 2021. That was 4 years ago. And so I imagine a lot of folks made exercise decisions based on an IPO happening because an S1 got filed and we still don't have one. So don't be too bullish on your company going public until the bell gets freaking ring at the stock exchange.
That is definitely, I 100% agree. It is definitely a milestone. But if you want to look at the cautionary tales around S1s, take a look at WeWork, ladies and gentlemen. That is the big glaring sign in the sky.
Oh, but they eventually went public. They eventually got it together.
Well, they SPAC'd, and I believe they're being delisted pretty soon. So
no bueno.
We have some fantastic clients at WeWork. Unfortunately, the story of their liquidity events has been a tough one. So I think that's enough for today. AJ, is there anything you want to add before we sign off?
I'm not qualified to continue talking about this. So
she's not quite satisfied.
Obviously.
Thanks so much for listening. Email us your financial problems at liquidityevent@brooklynfi.com. Leave us a voicemail at memo.fm/liquidityevent and we'll play it on the air. And finally, you stands can leave us a review if you want to be weird about it. Thanks so much, y'all.
See you next week.